Welcome to episode 19 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's interview is with Renaud Begins, one of France's leading independent sponsors. Renaud is not only very successful, very experienced, he's super charismatic, which of course always makes our job easier, makes for a really fun interview. Max, what did you think of this conversation with Renaud?
Well, I liked the way that Renaud described the niche that he and his group fill in Paris. And basically he says that he tells investment bankers to bring us your broken deals. And they position themselves as a solution for investment bankers, a solution other than traditional private equity, with the ability to close large deals that, quite frankly, are just a little bit too hairy for private equity funds. They've closed some very large deals, and that's very exciting. From a diligence standpoint, I particularly liked the way that they evaluate management when they're looking at making an acquisition. The selling company's management, he describes as being one of the most important factors that might determine the success or failure of the deal.
Yeah, he sees himself as almost the art of what he does is in choosing good management. He was quoting somebody else, but he talks about himself as a headhunter with a checkbook, like as if being a headhunter, being a selector of talent, is almost one of his principal duties, and doing that well is absolutely paramount. It's interesting because that is a soft skill. The other thing that he talks about, at where one of the themes of the conversation is where he adds value is operationally, as opposed to the kind of traditional private equity play of financial engineering. So operations, if you had to say hard versus soft, that's also kind of a soft skill. So he's a guy who really, he says that the hard skills of private equity, the financial engineering is a commodity. He says that explicitly, and it's really in these soft skills, in the EQ, the perceiving the strengths or weaknesses of management, the operational excellence, where he finds his own alpha. Pretty interesting. Nicholas, what did you think?
Yeah, I just want to emphasize this guy has been around the block. He's been a sponsor for 20 years. He's one of the leading independent sponsors in France and Europe and probably the world, honestly, when you look at how much capital they deploy. They've raised rounds of 200 million euros. And so necessarily the sophistication in their operations and diligence is a good notch above the average sponsor. Piggybacking on Max's first point there, Renaud talks about the Faustian bargain, which is a contrast between him and normal private equity funds. And so I press him on, hey, you're not Einstein, right? So why can you fix hairy deals, but other smart French funds can't? And he says it's because for funds, they have a tight mandate. So in exchange for committed capital that they receive from their investors, they have a very tightly defined buy box, like all funds. And because of that tight buy box, they're not able to participate on certain deals. And so Renaud is out there finding deals with 30 million euros of EBITDA and more, and he's getting them a 40% discount because he has cultivated an investor network and a track record to be able to consummate such deals. And he's not doing anything different. He's not smarter than others, but because he has the track record and that contrast, he can succeed where others can't even play. So that's his secret sauce.
Great. Well, did you guys have anything else, or should we play the conversation with Renaud?
Let's jump in.
Before we do, a reminder that Minds Capital continues to invest in independent sponsor deals. So if you are a sponsor raising for your acquisition, submit your deal to us. We're always at the other end of deal@mindscapital.co. And while I'm at it, we're also getting a lot of inquiries from prospective LPs in Fund 2. We haven't launched yet. That'll come later this year. But if you are an accredited investor and interested in potentially being an LP in Fund 2, there's a pre-registration form on our website. So head to mindscapital.co and look for that. Here is Renaud Begins, episode 19, Minds Capital Podcast. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. After graduating from HBS, Renaud Begins started a career in private equity in London. At the age of 33, he left big money in mid-cap PE to become an independent sponsor, managing himself acquired companies for the first 10 years, and then focusing solely on investing. His conviction is that financial engineering, traditional PE financial engineering, is often just a commodity, and instead seeks alpha through operational value creation between entry and exit, something of a back-to-the-basics private equity model. After 20 years as a sponsor, Renaud and his firm are now the leading deal-by-deal financier in France, executing lower mid-cap deals with hundreds of millions of euros of enterprise value. Renaud, welcome to the Minds Capital Podcast. More importantly, happy birthday.
Well, thank you very much. Joyeux anniversaire, as we say in France.
Well, we're flattered, if not a little shocked that you're spending it with us. So thank you very much for coming on. Let's start with a word that we heard you say in our pre-call. Why do you think a large part of your success, it comes down to being, quote unquote, crazy?
So I said crazy. If my investors are listening, I would say different. Well, I have started my career in private equity, and I had the chance to work with very smart people. So very, very strong at buying at the right price, doing some, I would say, sophisticated financial structuring, and selling at the good time at the right price. However, I felt a lot frustrated by the fact that we were, I would say, proposing to accompany and bring value to the portfolio companies. And in essence, frankly, we were, I would say, promising way too much compared to what we were delivering. And so I felt a bit frustrated. And I started to sense that there were some different ways to do private equity. And at the end of the day, the difference that we are proposing with our firm is, number one, a deal-by-deal model, which is extremely rare in France. It has started to develop in certain countries in Europe, in the UK a little bit, in Germany a little bit. There is an independent sponsor conference, by the way, in London. The first one started 2 years ago, so it's starting to emerge, but it's a very rare and unknown and unrecognized business model in France. And also, that's so first conviction and being different is choosing an independent sponsor model, so raising money on a deal-by-deal basis. And the second big difference is that it's true that we believe that the investment in private equity is better when it's done that we call the hybrid team. Hybrid team for us meaning I would say a team mostly composed of ex-CEOs, ideally of ex-CEOs within a LBO situation, but more importantly ex-CEOs. Why? Because we believe that number one, it's much easier to help a CEO or the COMEX, the executive committee of one of your portfolio company when you have done the job yourself about your value creation and also managing the company when you have black swans, very tough times, trying to rebound, recreate value. So when you have done it yourself, it's much easier because you have done mistakes, you have learned, and we believe you are in a better position to, I would say, coach, monitor, help the management of the portfolio company. So the two strong convictions, which are different from the market, is deal-by-deal fundraising and I would say a team composed of ex-CEOs. That is our difference.
Renaud, let's follow up on both of those. First, on the deal-by-deal model, the independent sponsor model. Why do you think that it doesn't have more traction in France? I recall from our pre-call, you're saying that even to the extent that it is known or understood in France, it's actually looked down upon. Why do you think that the market has responded that way or hasn't seen what you see?
Okay. Well, traditionally, I mean, the guy doing deal by deal, they are perceived as people who have failed to raise a proper traditional PE fund. So I wouldn't say that they are branded between bracket losers, but very close. And also, as it hasn't been done before, the market is not educated that you can deliver 20, 50, 100, 150 million of equity in a deal if you have a strong equity distribution platform. So it takes time. There is, I would say, a strong barrier to entry. You need to have track record, you need to have connection, and you need to have your own internal equity distribution capacity, i.e. big network, both of single family offices and institutional investors. And also, for big tickets, we have also a network of external placement agents / fundraising agents with different specificities, whether it's geographies, whether people focusing on single family offices, people focusing on institutional investors. So we have a map of people outside us, which we call an ecosystem. We have created an ecosystem, and so being able to distribute equity. But it's true that for the time being, when I talk to people who have difficulties to raise a fund, sometimes I say, why don't you do deal by deals? And the answer is, it's impossible. It's impossible. So either you can do 5 or 10 million tickets, so very small deals. On bigger deals, there's going to be a process, and hence you're at a disadvantage compared to, I would say, a committed pool of capitals. Now, the way we do it, most of the time, is we go for non-plain vanilla deals, i.e. either it's non-plain vanilla because of the company doesn't tick all the boxes for a traditional PE fund to engage, or it's non-plain vanilla because of the situation, i.e. there's a conflict between shareholders, it's an MBI, I mean all of these things. So we find situations where the funds are not aggressive, where we have, I would say, not only time, because you need to be able to raise your financing in less than 3 months. Otherwise, it's very difficult to be credible. But yeah, we don't go head to head with super hot sectors like tech, healthcare, all these things where you're going to have 5 traditional PE funds competing in phase 2. Engaging costs, due diligence costs in phase 2 to be able to be the guy paying 15, 19, 20 times EBITDA. So we are value investors. So the idea is to buy value investors. It's really by the book, the Warren Buffett way. So we try to buy good companies at discount. And good company at discount, it sounds, I would say, a bit counterintuitive, because if it's good company, you should pay full price. But because there is, as I said, non-plain vanilla situation. So it can be a company that 5 or 6 years ago was in very difficult financial situation, but they have turned around. The problems that used to occur are now solved. Many reasons why a fund or a manager, a partner in a fund, is going to be reluctant or hesitant to push this investment opportunity to the IC. And that's where typically the non-plain vanilla, so not ticking the box. I think the one of the key advantage of an independent sponsor is that you have freedom to choose your deals. And if you're right in the pricing, so it's a good company, say it's worth 10 times EBITDA, you buy it at 7 times. If you're, I would say, right in the pricing, because you have equity distribution capacity, the market will buy your deal. I don't believe that a good deal doesn't get finance. A good deal gets finance. And when I say good deal, it's the quality of the asset compared to the price. Mm-hmm. So there are a lot of non-plain vanilla situations where we can buy good assets at a discount. I'll give you one example, a deal we did last year with a single family office, a French entrepreneur. It's the number one company in France in the engineering of the external envelope of buildings. So it's doing architectural facades and mm-hmm. waterproofing of flat roofs. $500 million in sales. At the time, we priced on 20 million EBITDA. This year, so it was we priced late 2023. We acquired a company in April 2024, and now it's posting 33 million in EBITDA. And we bought it for 4 times EBITDA. Whereas the number 3 of the sector, which is 250 million of sales, I tried to buy it 4 years ago. The company is much smaller, and the value added of the services are not as good as the one we bought. And it went up to a PE fund for 7.2. So I tell you, people are always surprised, but the fact that we are known to M&A, to the big M&A houses in Paris, essentially we position ourselves as service providers to the M&A, to the sell side M&As. Hey. Whenever you have a failed auction, you call us. Whenever you have a primary situation that's too complex for the traditional PE fund, you call us. We are your partners. We help you do deals, get fees. We are service providers. We are liquidity solution providers. And we could almost say we are a continuation vehicle. So we create a pool of capital and to acquire the asset. But we are really, and we are pushing in our marketing to be seen as equity solution providers.
Renaud, in that deal, what was the complexity about it? Why had it not sold in a process?
Okay, very good. There is always a reason. It's like a diamond. A perfect diamond has a price. A diamond with a little defect has also a price. And you need to be able to analyze. So do a lot of research, your own research, independently of the public opinion of the PE world. You do your own research and you price. After that, the seller accepts your price or not. So on this point, there were, I would say, a couple of things. First of all, the company was posting negative EBITDA 5 or 6 years before. It was a turnaround done by a US PE fund. And whenever you are a traditional PE fund, you don't like to buy from distressed investors because it's very easy. One guy in the IC will say, well, it used to be negative. It could become negative again. That's, very, I would say, really not thought through type of discussion. But, you have this type of fear. And also, so it went from minus 5% EBITDA to plus 5% in 5 years. So giving you an indication of the quality of management, absolutely superb new management, gaining 10 points in EBITDA in 5 years. And also, I mean, the main point is that I would say about 30% of sales were in construction, new building, and residential building. And you may have seen that in Europe, this I would say the residential building is minus 50% in the past 2 years and a half. So everybody, as in the newspapers, it's a sinking market. So you have 30% of your sales at it. It's very easy for an IC to say, are you crazy? Are we going to say to our LPs, we're buying construction? That's a sinking market. Now, the trick, and I'm sorry to say it's very, we are not going to look very smart here, but the trick is this division was loss-making. So when a loss-making division has its sales sinking, the result on the consolidated EBITDA is that it goes up. So we don't need to be Einstein. This is not Einstein, type of analysis. But people got scared away because there was the word construction in the IM. Construction, residential construction. And so we looked at it. We thought the management was great. And actually, it was a call after the failed auction. And usually when we come in, we ask for two things. First of all, at least 30% discount to what they think is the fair market price, and exclusivity. If we don't get a significant or sufficient discount and exclusivity, we go work on another opportunity.
Are you only able to command those terms of looking at a deal, the exclusivity and the discount, if it's already post-process, a deal that's failed through a process? Or can you sometimes get that can you get a first look, even demanding those types of terms, discount and exclusivity?
Okay. Well, there are two other situations in which we can intervene. Number one is primary leverage buyouts. So typically, when you have an entrepreneur with a strong personality who hates a finance guy, who hates investment banker, and refuses to give a sell-side mandate. And as I was, I would say, managing an industrial group for 10 years, sometimes I can have the same type of language, and I'm not perceived as a strict and a pure financier. I can be seen as an ex-industrial guy. And so sometimes I manage to get one-to-one situations without any investment bank, sell side, nor buy side. And we can do a deal. We did such a deal last year. It was a second deal last year where incredible situation, a company with 18% organic growth, 45% EBIT margin. That's industrial tech. Industrial, the guys are producing 45% EBIT margin, 18% organic growth with a lot of patents, super technology. I asked a couple of friends in the PE community how much it's worth for you, 17, 18 times. We entered at 10 times. So again, we tried to have, I would say, 30, 40% discount. This was a primary situation. I had an angle with management being super difficult, difficult personalities. We managed to get around this, I would say, rough first contact, and they did the deal with us. So, and the second situation, so primary direct is a way another way to do apart from failed auction, and the last is the situation I just described. So there is a process, but management is with us from the beginning. And we consider and we have an agreement with the sell side M&A. We have an agreement also with the shareholders that, in essence, there is a process just as a backup in case I die in a plane crash, but otherwise the asset is for us. So we set a price, we do the deal. For them, the sellers, they will always say, "Oh, maybe you can die, or maybe you are going to fail this time to raise the equity." So we take a backup. There is a process, but it's you. And otherwise, if we are 1 out of 3 or 4, without the management in our pocket before the process, we don't proceed. We don't waste our time.
You said earlier in the call that you look at deals where other people are scared away. You don't have the herd mentality. And you look at targets that are a little differentiated because the situation can be special. So I wanted to challenge this because what I didn't hear yet is, why are you able to solve it? You did say that you don't have to be Einstein to go after this. But if you don't have to be Einstein, why are people so scared? There are a lot of smart people working in funds and in private equity in Paris and in France and in Central Europe. So what is it that distinguishes you to go after these deals?
believe me, it's not because I'm smarter. I'm not. But I have a competitive advantage compared to the business, the P fund business model. Because these guys have a big advantage. They have committed pool of capitals. But to get this, they have signed what I called the Pact of Faust, which means they have signed a charter investment. And you have two columns, the do's and don'ts. And as you have fiduciary duties vis-à-vis your investors who have trusted you with their money to do this charter and to apply strictly this charter investment, the do's and don'ts, you have, I would say, you are chained. You are chained to this investment charter. So that if the asset or the situation doesn't tick enough boxes to be compatible with your investment charter, even if you're smart and you would like to do it personally, you see it's a good big deal at a good price, you can't do it because it doesn't tick enough boxes. So the thing is, we do not have to tick boxes if we have, I would say, sufficient investor base. We have never had a deal which hasn't been financed.
What did you call it? The pact of
A Faustian bargain, I guess.
Yeah,
we say in English.
So you sign a pact, which makes that you have the money in your hand,
and it takes away your flexibility.
Exactly, right. Exactly. So all the guys, when I do the deals, some of my friends in PE funds say, "Bravo, we would have loved to do that, but it doesn't tick the boxes."
My next question here. You said that you raise money from a map of investors, and I would like to come back to that a little bit as well. But your investors, and you said that you are seeking and working with institutional investors as well. Aren't they also subject to a Faustian bargain?
Well, you know what? It's a good question. First of all, in the past, I would say we have raised money mostly from single family offices, whether they are French, Belgium, or Swiss. Now, as our tickets, equity tickets are growing, we are, I would say, developing our investor relations with institutional investors. And obviously, if we do very big tickets, we need to go to institutional investors. Now, institutional investors.
What's a very big ticket in this context?
Well, more than 200 million.
I see.
Yeah.
So single family offices can be well into the 8 digits, maybe even 9 digits. But if you need 200 million euros from a single party, it has to be institutional.
Well, we have, I would say, in our network, we have potentially, I would say, between 6 and 8 ultra net worth individuals who can put 200 million on the table on a single deal. But that's not a lot. Now we have, I would say, but on the other hand, we have 100 people, instrument people who can put, 200 or 300 million ticket.
Right.
But right. That's I would say that's more the future. Right now, I would say sweet spot for us is equity tickets between 25 and 100 million euros. Although we are now pursuing a deal where we raise about 200 million on a single deal, and hence. We are developing, I would say, external distribution equity platform with fundraising agents / placement agents.
You talk about equity distribution, and earlier in the conversation, you used the word map of equity investors. Can you elaborate a little bit on this? How are you organized? Maintaining relationships with large equity investors, and do you have a CRM? I'm just tactically curious. How do you build and maintain a network like that?
Okay, I wouldn't say we have a CRM. It's an Excel base, so it's very. I would say it's not very super sophisticated, but it's very intentional. So meaning that I'm 55. Although I put some creams every day in the morning, I look a little bit younger, but I'm 55, and I've been entrepreneur since I was 15. And at 25, I realized that I couldn't do a big business without external funds. So I started to do my own Excel spreadsheet. Whenever I meet somebody, whether it's a ultra net worth individual or whether it's potentially an insurance, whatever, pension fund, bank, whatever, I have my own CRM. So I have done input almost every day for the past 30 years, almost everyday entries in my CRM. This file is super, super important for me, so I save it on many files every week, many clouds and many storage keys, whatever. And this is all my knowledge. When I read a paper, I see somebody who's done Harvard Business School. I see somebody who's done a school I've done in Switzerland. I link a little word on LinkedIn. It's a daily job. It's a daily job I've been doing for 30 years. Really. So this is, I would say, internal. Obviously, I have with me some of my partners, or whether it's my advisory board, or whether it's my team of operating partners. They are also bringing some, I would say, potential investor connections. And then outside of the ecosystem, the Ceres industry capital ecosystem, we are, I would say, also hiring placement agents based on their specificities. It can be country. A guy is super good in Switzerland. It can be institutional investors, and it can be also ultra net worth individuals. Sometimes you have gatekeepers. They know 2 or 3 billionaires, but that's very good for us. So we're trying to do a map, say, who can introduce us to ultra net worth billionaires in Switzerland, in Belgium, in France, in the UK. Same for institutional investors. So we try to have a map like this.
So who are these gatekeepers who have access to 3 billionaires at the time?
Well, it's I will give you the names after the call. I should be.
But no, it's more like I'm wondering about the profile. I mean, where do you find them, and what do they look like? What's their business title? I haven't quite heard.
It can be multi-family offices.
Right.
It can be I would say people doing co-investments and having a couple of key anchor investors. Well, there are different, it can be M&A guys, like obviously Rothschild. The Rothschild family has a lot. Look at their private banking business. They have a lot of billionaires. So, and we are, I would say, partners on a lot of deals, whether they are M&A on our side, whether they are helping us on the debt advisory. So there are many ways to access billionaires.
So you have this directory of people that you started 30 years ago, and you add people as you go, both people you meet, it sounds like, but also people you read about. How extensive is this list?
I would say I have 1,000 potential investors right now. And each time I have an information, I put it. So it can be a name, it can be an email, it can be a mobile. And then all the investment criteria. This is super important, because if you have the list but without the investment criteria, it's not really worth. And then whenever I start a deal, we looked at this spreadsheet and we do a selection. This is the type of guys, type of ticket, type of industry sector, type of geographies, type of risk profile of the company. And we do a first selection. And, then we have, I would say, preferred relationship with some, placement agents. And then we call them and we say, okay, this is the deal. Do you think you can have traction on that? And we exchange, and we have their first impressions and whether we feel very comfortable on the raise.
So if you read about someone in a newspaper, in Financial Times, and you add them to your list, what's your approach after that? Do you reach out to them for a coffee? How much time do you allocate to, the personal aspect of meeting people and maintaining these relationships in this list?
Okay, first of all, I mean, we very rarely do cold calls. We only do, so even if I don't know the guy, we put it, and at some point during the years, somebody's going to say, oh, I met this guy. Okay, this guy. I put it. So the question is, who can give me access, a warm call? Who can recommend me to this guy? Okay, so it's never a cold call. A billionaire is not going to answer. He receives 100 mails every day. So you need a trusted advisor, a friend, an ex-business partner. Say, hey, James, you should really meet this guy. I think he has a nice one for you.
Yes.
This is what you need.
And when you think about time allocation. You're pursuing new deals, you're closing new deals. We'll get into it later, but you're also very hands-on in operations with your team. So how much time do you allocate to this directory of 1,000 contacts that you try to maintain and keep warm for future opportunities?
Well, I don't keep track. I mean, frankly, it's already, I would say, it's quite massive, although it's a fraction of the potential market in Europe. And obviously, we have also a relationship with some US investors. But right now, I don't spend a lot of time on this. I would say our deals are increasing in size. We are building a portfolio, and so we need also to build a team. So we have an investment director who is super sharp, I would say, and does a super job in, I would say, in the execution of the deal and also in the negotiation. We will probably bring a second partner and potentially a third partner within 6 to 9 months. And the key for us would be also to develop our investor relation function internally. So I have somebody helping me half time on the investor relation. But this is key for us because the independent sponsor, you have two goals, and you shouldn't mix the two goals. The first goal is to close the deal. The second goal, which shouldn't be first in your mind, is to maximize the economics for you. Obviously, to try to, I would say, prefer smart investor than people bringing nothing. But the idea is to maximize the economics only when you are oversubscribed. Some people are, I would say, too tough on the fees carried negotiation and they don't close the deals. So you close the deal when you have, let's say, 100, and then you start to go oversubscribe, kind of book building for an IPO. And when you are at 120, 130, you call the guys who are too tough on negotiation and you say, look, mate, the price is this one. If you're not adjusting, you're out on this one. You'll do the next one. But you were at you negotiated too tough, so you're out of the deal. So, but to do that, you need to be oversubscribed. And again, you shouldn't pursue goal number 2 before making sure you are already closing the deal.
So you go raising for the deal, you fill it, you get all the commitments that you need, and then you keep raising to oversubscribe and go return to some of the folks who negotiated pretty hard with you in the initial round of raising and try to bring them back down now that you've created leverage for yourself by getting it oversubscribed.
Correct. I mean, at the time, at the start of the book building of the, I would say, fundraising, we're not very tough on negotiation. We are proposing our terms. So people are doing some counter proposals. We don't negotiate. We take what it takes. Otherwise, if you try to negotiate and you strike an agreement, then they don't understand why you are going back to them after. So, we listen to what they're saying and say, okay, we hear what you say. It's far from what we asked. So there are very little chances that you're going to be out of the deal, but that's your choice. And obviously, we try to be fair to everybody. So for those who have committed early, we say, look, guys, this is the pricing. What are you doing? Are you adjusting? At the end of the day, frankly, whether you take 8 or 15% carried interest, I think this is not what's important. If it's a good deal, the net after management package and net after carried is good. Is good, I would say, on the Ceres business plan that we underwrite between brackets, and also if we do a flat case with ISO multiple between entry and exit, if you manage to do 2 times your money without increasing EBITDA and without increasing multiple, or potentially with a slight decrease, because if you're flat, you're not going to get a great multiple, and you make 2 times your money, it's not a risky deal. And so the pricing is justified.
Renaud, let's return back to something we said in your intro. That was part of your differentiation, part of your crazy, which was that you lean on operational excellence, operational improvement to create value as opposed to traditional financial engineering. It sounds obvious, improving the quality of the assets by improving their operations should increase value. And yet in private equity land, you don't see it very often, to your point. And in fact, Nicholas, I think you've cited data a lot that a lot of the value creation actually has not come from that. And so just traditional financial engineering has worked. The returns have demonstrated that it does work. So maybe I've just answered my own question. That's why private equity funds continue to do that. But why do you focus so much more on operations versus engineering?
Okay, actually, we do both, and we try to be smart in financing the deal, and we try to bring more money. Everybody does that. We try to do it, but first of all, I mean the basics. Value investing. That's first principle. You buy good companies at a discount. Number two, and before the operational value creation. Number two, the key parameter in our investment decision is quality of management. Before strategic analysis, before financial analysis, I will give you one sentence I like from Mr. Henry Travis. Somebody asked about his job. What are you doing? What is private equity? His answer is, I'm a headhunter. The only difference with a headhunter, traditional headhunter, is I have a checkbook. Which means the key analysis on which you shouldn't, pardon my French, fuck up, is the quality of management. Mr. Buffett, Warren Buffett, he says, I look for two things in management. Number one, people who are honest/loyal. Number two, people who are smart. If the number one parameter is not ticked, i.e. the guy is dishonest, we hope he's not going to be smart. Otherwise, it's matter of like. So we are very basic, we stick to basic. Are the guys honest, transparent, very good references? Can we build trust-based relationship? Is the guy good? When I say good, two comments. First of all, good means you are able to overperform your industry. So if you have a 5% market growth, are you able to deliver 8 or 10%? Saying his company is doing 10% organic growth, his company is doing minus 5% organic growth isn't meaningful. If you do -5 where the market is minus 15, you're a star. If you do +10 and the market is at +20, you're not very good. So we look for people who can deliver and team who can deliver sustainable, superior growth and margins. So value investing, quality of management, and then we have, I would say, an OVC, operational value creation system that has a few components. One of them is that we have a strong conviction that the investment private equity business is better done with hybrid teams. And I was mentioning that is teams with a majority of the partners who are ex-CEOs, ex-people who have themselves creating value. And for a reason I must say I don't quite understand, there are very few. I'm talking on the small cap, mid cap. I'm not talking about the KKR with their capstone. Some people have dedicated OVC teams. I'm talking about this type of size. And if you look at the composition of the teams, I'd say that less than 5% of the partners in PE funds are ex-ECOs, less than 5%. Now, in our team, we want at least 50 or 60% of the team to be ex-CEOs. So the first block, we believe, is through the investment team. And sometimes people are saying, well, but if you are an ex-operators, you don't know the financial engineering. I say, well, a big industrial group, I was talking to a CEO of a big industrial group, he says, I don't understand these PE guys. I buy 50 companies a year, and I sell 30 companies a year. What are you saying? I don't know how to buy and sell a company. I know what they know, but I know how to manage the business and create value. This they don't know. So for us, the key is really bringing And not saying we have an operating team and we have, I would say, the deal makers. No, it's the same team. Because people who have been in the managing businesses, they have bought and they have sold businesses. They know it's not, that's why I say it's a commodity. What's not a commodity is be able to create value between entry and exit. That's superior management. And we believe superior management is rare. Again, we disagree with the fact that you can just fire a CEO and replace, call a headhunter and replace. Superior management is rare. And hence, that's, I would say, a very block. So if you do buy a good company on the cheap, you have a good management, honest, superior delivery, and you have ex-partners who are ex-CEOs themselves. That's a good start. The two other components is that we have a team of about 12 operating partners, and then we have a wider ecosystem. And essentially, whenever we look at a company, we try to find either sector-focused expertise in our, I would say, pool of operating partners or functional expertise. So that when we go in the first meeting, management meeting, we have one or two guys, whether they know the sector by heart or whether there is, I don't know, an e-commerce or supply chain problem. We try to buy a specialist, and they're already part of the team from day one. And one of the deals we are working on, there was, I would say, an area of improvement / a weakness in the company. We brought an operating partner expert in the field. And after the second meeting, management was taking notes. And at the end of the meeting, they said, can you please make sure this person is on the board?
Can you talk a little bit about how you attract operating partners? Or you mentioned someone who would be an e-commerce expert and can come in and immediately have that authority with a target. How do you attract that kind of talent, and how do you compensate them and keep them engaged? Because presumably they're not full-time employees in this particular portco.
No, they are not full-time, but they are people who have excelled in their field. So we have a track record of operational value creation, and we have an agreement with them, which is a special agreement. I will comment on that. And the idea that they agree to dedicate enough bandwidth so that when we do a deal, they can be on our side during the due diligence analysis and potentially be also on the board after if we close and after we do the investment. And so they are remunerated. There are different ways. Some prefer to be on fixed type of contract, so you're paid whatever price per day. Some people prefer success. Obviously, if you take the success, in case of success, you get much more than if you take the fixed salary per day. And then for those who bring significant value, there's a piece of carry. So the idea is that is to compensate people for what they bring. Really,
but do you compensate them out of the GP side, so on the Ceres side, or on the portfolio company side that they get, for instance, stock options?
Well, no, they would get if they get carried, it's a piece of our carry, and on the, I would say on the, let's say, salary or especially post deal, because obviously pre-deal it's us. If we can charge, I would say, some classically, we can charge some closing fees. Often, and I would say in most cases, we charge monitoring / board fees for the time we spent on the asset. And so a portion of this is, I would say, is shared obviously with the people working on the investment.
Yep. How do you go about, you call it a quality of management analysis, which is a nice kind of a sister to the quality of earnings we all know so much about. How do you go about, in your case, doing a quality of management analysis? You shared a little bit on the pre-call, and I'm curious to hear more about it.
Okay, that's a difficult one. I would say hiring, I would say assessing people is one of the most difficult job as an investor and also as a CEO or a manager. When you are very experienced, I think you miss the target 50% of the time. When you are very good, why? Because you have a smart guy. He wants you to do the project with you, so he's going to say everything he needs to say. Even if you take references, he's gonna obviously if you take the references he gives you, nobody's gonna say a bad thing about him. So you need to do other references, and it's difficult. And sometimes we make mistakes. One of the way we try to diminish the rate of mistake, the percentage of mistakes, is that we have at least two people apart from me and one of my teammates, and a woman, and she's very soft. She has super good, I would say, listening skills. So we have this type of assessment, which is very soft assessment, but it's very, very precise. And I must say that we haven't missed a lot thanks with this analysis. Whenever we do this analysis, frankly, we have never taken a guy who was totally wrong and totally mistaken from compared to our analysis. I have two special partnerships with headhunters. One is specialized in assessment. So he does, when we have a question mark, we'll do a second assessment. And then I have a second partnership specifically for MBIs. Because MBIs is also a situation where a lot of PE funds are uncomfortable. And so for us, it's also...
what is an MBI, just clarify?
Sorry, management buy-in. Management buy-in, so it's when the owner is saying, okay, I give you the keys, I can reinvest 20-25%, but you need between 1 and 2 years to bring a new guy who's going to take over. Usually what we do, we are very pragmatic, and we say we don't want to set a fixed time, because again, we might be wrong in the hiring. And if we say to you, you're gone in 12 months, assume we make a mistake. After 6 months or 9 months, we fire the guy. Mistake. Well, you can't leave 3 months after. So we say, you can leave the company, sir, only when you and I are happy that we find the gem, the new guy, that you have handed over, we are comfortable, you can go enjoy your money with your friends and so on, but only when the company is safely managed. Only then you can leave. So if we are right on the first hire, maybe it's in one year. If we're wrong on the first hire, maybe it's 18 months. So I'm not saying setting up a type up front. The idea is that we make our best effort to put in place, obviously, the best manager that satisfies you. You're going to see the guy, you approve it. I'm not imposing that on you. But let's be also humble. We make mistakes. So we have to take some margin of maneuver in case of a mistake.
So to summarize, the quality of management analysis, and when you interview someone, and I think this applies not only to your recruiting, but also to when you look to partner with a seller, right?
Sure.
And they're going to be a partner going forward. It includes not only the regular process of interviewing and liking each other and exchanging values, but it includes reference calls. It includes headhunter, what was that part again? It's... the headhunters will approve, or
the assessment part. But it goes back to what Mr. Kravis is saying. I'm a headhunter with a checkbook.
Right.
So this is the key part. This is much important than crunching the Excel numbers, crunching the function, and crunching the strategy. And I'll give you a sentence that, or principle that a very, very high-profile industrialist in France told me when I was very young. He told me, the future is uncertain. I disagree a little bit, because we know that taxes are going to go up and we're all going to die. So there is a few things we know about the future, but let's assume the future is uncertain. When you buy a company, whether you're the manager or your investor, there are going to be bad surprises and good surprises. That is the only thing you know, bad surprises and good surprises. If you have a good manager, when there is a good surprise, let's say a competitor is going bust, you need to move quickly to buy him out of bankruptcy. Otherwise, somebody else is going to do that, and it's going to be much bigger, and it's going to be, it's going to be devaluing your assets. So this is an opportunity. Either you say, oh, it's risky, you hesitate, and somebody else take the opportunity, or you, I would say, positively, aggressively take the opportunity. A good management, when there's a surprise, It was not in the business plan that our competitor was going bust. That's a good surprise. You take this opportunity. That's a good management. Now, when you have bad surprises, 2006 to 2007, oil price from 30 to 128. That's 2006 to 2007. Whoops. 2008 to 2009, global financial crisis. 4 years of black swans. COVID. If you look at the percentage, there's a very interesting statistic about the percentage of holding period and percentage of black swan. If you hold an investment 5 or 6 years, the percentage of black swan is 80 to 90%. Okay. There are a lot of consequences. But what I'm saying is, if you have a black swan, the good manager is going to diminish and to minimize the impact on the business. So again, it goes back to what I was saying. Choosing a superior management is the best insurance against the uncertainty of the future. They will take the good surprises and they will rebound, minimize from the bad surprises. And so everything is summarized in that. And it goes back again to headhunter with a checkbook. I just add to Mr. Kravis, headhunter with a checkbook with operational value creation capacity. There's a third element in our views. But so this is key. All goes back to the quality of management.
You've been doing this for 20 years in a space that other people to this day in France call impossible. You've built a portfolio. How do your returns compare to the general market, would you say, at this point? Do you have a sense for that?
Well, the market is in France, it's 14%. After fees, after carried, 40% leverage buyout.
14, yeah, 1.4
yes.
IRR in the LBO space.
Yes, and so far we are at 24% since its inception. Now, it's not really fair to compare because we are, I would say, people would think that we are taking more risk because we are doing non-plain vanilla situation. I don't know about that because if you think about risk, you need to think also in terms of leverage. Most of our deals are, I would say, about 2 times EBITDA in leverage. Why? We don't want to add an financial risk on top on an operational risk. So whenever there is a situation we need to fix, we don't do distress, obviously, but we try to not put a lot of leverage at the start. Most of our companies, we help them do build-ups. So if you do build-ups, you will leverage your company. And if you don't manage to do build-ups, well, you can do a recap, in 2 years or something. But I prefer to do a recap in 2 years than putting too much leverage and then hitting a black swan and putting my investors at risk. I will just... Maybe I can give you an example of the first company we acquired. Actually, so I bought it, I was 33. I was a PE investor. And I left my PE investor job. At the time, the people in my team didn't understand why I would buy a small industrial business and leave, I would say, carry and bonus. The anecdote is that my boss wanted me to stay. So he said, how much money do you want? He took a checkbook and he said, how much zero do you want? And I didn't know what to answer. He said, $1 million. Is it okay? I was 33. And I didn't want to stay. And I didn't know how to argue. So I said, the key argument, I said, it's not about money. And so when I said it's not about money, you say, okay, you're gone. I leave you go. Because
I've lost you.
Even if money is not important for you, you have an entrepreneurial project. I respect that. Good luck.
Right.
And so, people, obviously, some people were thinking I was crazy. And though I managed to become a CEO, so I bought a company. It was, we raised 25 million, 12.5 of equity, 12.5 of debt. And I became, from one day, a PE financier in London. And then I became a CEO in a small province in an industrial company in France. And
Renaud, how big was that business? Can you give us the bullet points on that business?
Okay, 37 million sales, 4 million EBITDA. We grow it to 64 million, four plants, 330 people. So we were formulating and producing some hygiene and care liquid products, such as detergents, disinfectants. Also, we had an automotive division doing all the technical fluids, so brake fluid, cooling liquid, motor oil, this type of stuff. And I then bought a healthcare business doing disinfection, but specifically for hospitals, for dentists and vets. Now, I bought the business. I didn't know, apart from managing 2 associates and my secretary, I've never managed people. So this was a challenge. And then 2 years after acquiring this, I told you I had 2 black swans. So 2006, 2007, oil price going for $30, from $30 to $128, which was a tsunami. I had 60% of sales, 66% of sales was COGS related to oil. So if 66% of your sales triple, you have a problem, right? So you go from 10% EBIT to minus to 50% EBIT. That's why I call a bad surprise. Bad surprise. How do you react to that? So we had to reinvent the company. We went into a crisis mode. Obviously, when you have leverage, all the covenants are gone. What we did right is, again, following Mr. Warren Buffett's recipe. We kept cash on the balance sheet. I've been to 2 business schools. The first one I didn't understand. The second one maybe a little bit more. But one thing they say is cash, you need to optimize. I argue that cash is a super good investment. Why? Because when you have a black swan, you are able to keep your equity. And then sometimes people are less cautious than you. And I mentioned you in 2008, one of my competitors, I bought it for 1%, 300K compared to 30 million euros. That's the cost of financial distress.
You mean it was valued at 30 million prior to the crisis, and then their balance sheet was shot, so they dropped 99% in valuation to when you acquired them.
Well, investment bank proposed me to buy this company for 30 million. It was my competitor on the automotive side. And 2 years after, they went into bankruptcy due to 2008-2009 crisis.
Right,
I had cash on my balance sheet, and I bought the assets out of bankruptcy for 0.3 million. So the cost of financial distress, that's the reality, 99%. You lose everything.
Yes.
So as I don't want to lose my money, I don't want my investors to lose money, I keep cash. And it's very rare, again, if you have 5 or 6 years of investments, it's very rare that you don't have a crisis. And when you're going to have the crisis, first of all, you're not losing your equity, and potentially you can be tactic. And as I was saying, size, a good surprise.
How much cash do you normally would recommend in operations for a company? You know, how many pay cycles and how many cycles of payables should you be able to get through?
Okay, I don't think in terms of this term, you're too sophisticated for me, Niklas. What we do is we try to think in terms of gross acquisition debt and net acquisition debt, obviously the difference between cash. So typically what we would do is say, okay, we put 3 times EBITDA in terms of I would say gross debt at closing, but we keep one turn of EBITDA in cash. So 3 minus 1. In essence, you have 2 times your leverage, 2 times net leverage. Okay. So, but we keep cash on the budget, and again, it can save us if there's a black swan. It can be tactically used in terms of distress to buy a competitor, or sometimes it's used for build-up. So I will not compromise on, some investors, they say the first time they say, oh, give away the cash, do a big dividend. The IRR is better and your management package is better. I say, this is what you learn in business school, but that's not what's happened in reality. I will need the cash when the prices will hit. And so I kept the cash when I did the management buy-in. 2 years after, just before the oil crisis, they pushed me to do a recap. And I opposed. I said, no. If you want to do the recap, you fire me, you buy my shares, and you take a new CEO. But I defend the social interest of the company. This is a bad business decision. I oppose. Now, you're the majority shareholder. If you want to fire me, no problemo. They didn't do the recap. Then the oil price went from 30 to 128. There was an urgency meeting and say, Mr. President, what do we do? I say, first of all, I checked your website this morning. You said you're a value investor. You are creating value. You're helping your companies. You are experienced. So I listened to your suggestions. Big silence. Okay, Renaud, stop joking. What are your solutions? So those are the solutions. But before I say the solutions, I want you to say thank you to me and my team because we have resisted your stupid business decision that would have brought us in bankruptcy. So first of all, you say thank you. And then we will tell you the plan to try to survive. Okay? So, and then we survived. Okay, we managed to reinvent. So obviously when you do in crisis mode, I had to get rid of 80% of the executive committee because doing in crisis mode is not the same type of management. We had to reinvent everything. So the key message was we are going to work on the formula of the products to do better products at cheaper price. I would say people working in the lab say, how can you do something better with a cheaper price? I don't know. You'll do it. So we had to rework everything on the, I would say, chemical formulas. Also, we worked on, industrial plan. And then we did some distress M&A to recreate value. But we would have died if we had listened to please do the recap. Your financial structure is not optimized. This is crap, business school crap. The reality is you need cash. Again, the future is uncertain. Be able to have a good management, sizing the opportunity, but to size the opportunity, you need cash. So good management and cash and patience.
Renaud, it's interesting because on the one hand, as you said, the perception of you might be that you are risk on, that you go after more risky opportunities than the plain vanilla private equity folks. But from this perspective, you are, I don't want to say conservative, but you're more conservative when it comes to cash management, and you've got the track record to demonstrate why. But I think most people would call that, if they had to give it a label, conservative. So you don't fit neatly into risk on or conservative. You find your own way, which is I guess what you've said before. You're not crazy. You're just an independent thinker.
Well, I think I'm not conservative. I'm just realistic.
Yeah.
Again, I have principle, and future is uncertain. So saying you can take all the cash from the balance sheet because I know the future, I don't have the crystal ball. My investors don't have the crystal ball. So cash is our only protection, because if you go back to banks, when your covenants are gone, they're not going to lend you. You know that. And so if you bring in equity, you're totally diluted and you're back to financial distress. I have never lost money in 20 years. The worst deal we've done is 1.3. Unfortunately, it was the first deal when I was manager. So there's probably a correlation because the worst deal and me being the manager of the company. But more seriously, it was a 6 year of investment cycle with 4 years of Black Swan. So it's like you have 2 COVIDs in a row. If you managed with 2 COVID in a row to give back to your investors 1.3, I think that's decent. And I was mentioning that in our investment notes, just after the executive summary, we don't do all the highlights why you should buy the deal. Apart from the we start by risk and risk management. We are not sellers. We are a trust-based business. People, I would say, invest with us because they trust us. If you only put the positives, you are just selling carpets. You're not investors. So you need to be fair to investors and to show that you've done your homework, analyzing the pluses and minuses. So we start with the risks and the way we manage risk, and why we think the discount we got is a fair pricing of the risk that we have identified. Again, you might. I'm not. I disagree with the term conservative. I'm just realistic. We are, I would say, very, very, very to the ground, basic people to the ground. By the way, Ceres, our logo and our name is the goddess of agriculture. So we are not Wall Street financier. We are agriculture. We are people working on the land. We know that you need to choose the seeds, to plant the seeds at the right season, to put some water, to protect from the sun, to protect from the freeze, and harvest at the right time. So really, again, it's about being feet on the ground, focus on value creation. Obviously, we try to do some nice structuring, financing, but this is the key, and I think it's very consistent with our value. But again, the worst is 1.3, 4 years of black swan in a 6. And I start usually when we do the cases. We do obviously some cases that have worked nicely, but I always start with the worst performance. And I tell them it's not a promise. But I tell them, even with 4 years of black swan in 6 years, you can still give back the money to investors. And I think it's also part of our values to never give up. Never give up. It's not only for my money and for the money my partners have put in the deal, but it's for the money that people have trusted us with. And so it's not a matter of money. I think it's a matter if we fail to do whatever we can do to save the investment and to give back the money and potentially with a capital gain, I think it will be so ashamed that potentially we would stop operating. I think it's inconceivable for us not to make a profit on a transaction. Now, obviously, if you have 5 black swan in a row, maybe we'll give up. We'll make a capital loss. But what I'm saying very seriously that we take our fiduciary responsibility extremely seriously. Whatever the carry agreement, even if we are below the water, we want to fight until the end to give back the money and to give the best capital gains for investors. We never give up.
We had another sponsor on an episode recently, actually it aired this week, who similarly talks about his worst deal in terms of returns, but it was also his finest hour because it is in the Apollo 13, as he calls it. It is in the crises where your grit and your abilities and your talent and your commitment, your fiduciary commitments are really demonstrated more than when things go great.
Exactly.
Renaud Begins, thank you very much for coming on Minds Capital Podcast. We were thrilled after our pre-call with you to get your story and to share it with us publicly. We know you don't speak very often publicly. We know that you've been having a lot of success, but doing so quietly. So this is a rare opportunity for the world to learn what you've been building. So thank you very much for coming on. Thank you for coming on your birthday. Happy birthday. We look forward to continuing in contact with you.
Well, thank you so much, and I really enjoyed discussing with you guys.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.